Hey everyone, welcome back to the channel. I'm so glad you're here because today we're going to talk about something that can truly make or break your home buying journey, your credit. I've worked with so many buyers over the years, and one of the most common concerns people have is whether their credit is good enough to qualify for a mortgage. The truth is, even if it isn't where you want to be right now, it doesn't have to stay that way. Credit can be improved, and often in less time than you might think, if you know the right steps to take. This isn't going to be a quick list of tips you've already heard 100 times. We're going deep into understanding exactly how credit works and why certain actions help and others hurt, and how to create a plan that actually moves your score in the right direction. I want you to imagine for a moment that your credit score is like a financial trust meter. Lenders look at it to decide how much risk they're taking if they loan you money. A high score tells them you've managed your debts well in the past and they feel confident you'll pay them back. A lower score suggests you've had some struggles, or maybe you're new to the credit and haven't built the track record yet. The great news is your score is not set in stone. It's constantly being calculated and recalculated based on the most recent information in your credit reports. That means the actions you take starting today can begin influencing your score almost immediately. And over the next few months, those small improvements can add to big results. The first step is fixing your credit is knowing exactly where you stand right now. Many people don't realize that they have 3 separate credit scores, one from Equifax, one from Experian, and one from TransUnion. Each report may have slightly different information and can lead to a slightly different credit score. That's why it's so important to pull all 3 and review them carefully. You can get free copies of your report every year at theannualcreditreport.com, and some lenders or financial institutions will even let you check them more frequently. When you look at your reports, you're not just checking your score, you're reading the full story of your credit history. This is where you can spot mistakes, outdated information, or accounts that don't even belong to you. You'd be surprised how often I've seen errors drag someone's score unsuccessfully. If you find mistakes, you have the right to dispute them with the credit bureaus. The dispute process can take a little time, and usually around 30 days, but it's worth it if you can get negative items removed that shouldn't be there. Even something as small as a late payment reported in error can cause your score to drop by dozens of points, so accuracy really matters. Sometimes the hardest part is knowing which battles to fight. For example, if you have a legitimate late fee from a few months ago, disputing it won't get you anywhere. But if you see an account you don't recognize or a debt that should have fallen off your report because it's more than 7 years old, that's worth challenging. Once you know your reports are accurate, the next phase is about managing your current debts in a way that helps your score improve. One of the biggest factors in your credit score is your payment history. So making every payment on time from here on out is non-negotiable. Even if you can only make the minimum payment on a credit card, paying it by the due date keeps your record clean and prevents new late marks from appearing. This is where having a system to stay organized really pays off. Some people set up automatic payments so they never miss a due date, while others prefer calendar reminders or phone alerts. The method doesn't matter as much as the consistency. Another huge factor in your score is how much of your available credit you're using, what's called your credit utilization ratio. This is the balance on your credit cards compared to the credit limit you have. Lenders like to see that number low, ideally below 30%, and the lower the better. So if your cards are maxed out, your score will take a hit even if you've never missed a payment. Paying down those balances can be one of the fastest ways to see your score climb. For example, if you have a credit card with $1,000 limit and you're carrying an $800 balance, your utilization is 80%. If you can bring that balance down to $300 or less, you're showing lenders that you're not overly reliant on your credit, and your score will reflect that. Sometimes people ask whether it's better to pay off one card completely or make small payments across several cards. The answer depends on your situation, but generally getting your highest utilization accounts down first will give you the biggest boost. So once you pay down your revolving credit, the key is not to rack it up again. This is where budgeting and tracking your spending come into play. It's easy to swipe a card without thinking, but every purchase adds to your utilization and can affect your score the next time it's calculated. So if you don't have much credit history at all, your score might be low simply because the credit bureaus don't have enough information to judge you. In that case, building new positive history is important. This can be done by opening a secured credit card where you put down cash deposit that becomes your credit limit, and then using it responsibly. Another option is to become an authorized user on someone else's well-managed account, which lets their good payment history show up on your report. The key with either approach is to keep balances low and make payments on time. Debt collectors are another area that can drag your score down. So if you have accounts in collections, you'll want to address them. But how you do it matters. Sometimes paying a collection won't immediately raise your score because the fact that it was in collection stays on your report for 7 years. However, newer scoring models give more weight to unpaid collections, so settling them can still help. You might also be able to negotiate with the collection agency for a pay for delete, where they agree to remove the account from your report entirely in exchange for payment. Get any such agreement in writing before you send money. It's also important to avoid taking on new debt while you're working to improve your score, especially if you're planning to buy a home in the near future. So every time you apply for a credit, the lender does a hard inquiry, which can lower your score slightly. Multiple inquiries in a short time can have a bigger impact. New accounts can also lower your average account age, which is another factor in your score. So if you know you'll be applying for a mortgage in the next 6 to 12 months, focus on improving the accounts you already have instead of opening new ones. Credit repair is not just about raising your score temporarily, it's about building long-term habits that keep your score healthy once you've improved it. That means living within your means, saving for emergencies so you don't have to rely on credit cards for unexpected expenses, and keeping your utilization low even after you pay down your balances. Over time, your positive habits will outweigh the negative marks in your past, and your score will reflect the process you've made. So when it comes to timeline, I've seen clients raise their scores by 50 or even 100 points in just a few months, depending on what's on the report and how aggressively they address it. For others, especially those with major derogatory marks like bankruptcies or even foreclosures, it can take longer. The key is to start now because every month you're making a positive change is a month closer to your goal. As a realtor, I can tell you that having a higher credit score doesn't just make it easier to qualify for a mortgage, but it can save you a lot of money. Lenders use your score to decide what interest rate to offer you, and even a small difference in rate can change your monthly payment by hundreds of dollars over the life of a 30-year mortgage and can add up to tens of thousands of dollars saved. So when you put in the work to fix your credit, you're not just increasing your chances of getting approved, you're also setting yourself up for a more affordable homeownership experience. The journey to better credit isn't always easy, but it is always worth it. It takes patience, consistency, and a clear plan. Start by knowing exactly where you are, fix any errors, manage your debts wisely, and build new positive history where you can. Avoid new debts, stay on top of your payments, and remember that every step you take in the right direction brings you closer to the day when you can get the keys to your new home. If this is the first time on the channel and you want to know everything there is about living in Northern Kentucky and the surrounding areas, then subscribe below, tap the bell for notifications so you can be the first to learn about the current market in Northern Kentucky. My name is Carrie Empero. I get calls and emails every single day from people like you, and you looking to make their move to Northern Kentucky. So whether we're moving in 9 or 90 days, just give me a call, shoot me a text, or send me an email. Happy to help you make a smooth move to Northern Kentucky.